evening and welcome everyone. Thank you for joining Quantum Mutual Fund's webinar. My name is Raina Shivdasani and I will be hosting this session. The topic for today is Pandemic Impact, Economic Recovery, Investment Strategy, Insights Revealed. I would like to begin by introducing you to our speakers for this evening, Mr. Chirag Mehta, Senior Fund Manager, Alternative Investments, and Mr. Sorbh Gupta, Fund Manager, Equity. Before we begin the session, I would like to request you all to plug in earphones for an optimal listening experience and ensure you are connected to the Zoom audio. Additionally, during the session, please type your questions into the chat box, which our speakers will address post their presentation. Over to you, Chirag.
Thank you, Raina. And thank you everyone for logging in today. We are kind of in a very uncertain and tough situation where we kind of were hit by the second wave of COVID, and now we are kind of seeing that curve kind of move down. But what the future holds, will we get a third wave? What kind of numbers are we seeing? Are the numbers accurate? And what is the impact on financial markets? Or how you should position yourself? Those are the things that we'll talk today, and probably get you more insights on how to position your portfolio based on these insights. So if you look at not only in India, many of the global economies or most of the economies out there had a second wave and a third wave, right? But if you look at the India second wave was far, far larger, given the sheer size of the population that we had. And this time it kind of spreaded, it was not limited to urban cities or metro cities. It kind of reached the rural areas as well. And it's kind of creating a havoc, given that the healthcare facilities out there in the rural areas is not that at par, when even metro cities were struggling with many things like hospital beds, oxygen, medicines. You can imagine the toll it would have taken on the rural areas. So we have a fairly sharp second wave, and now the curve seems to be subsiding. But if you were to look at on a like-to-like basis, when you compare with the global economies, right? What kind of numbers were we seeing, right? If you look at, these are testing numbers. So number of tests on when the second wave started in various economies like India, France, Italy, Switzerland, UK, and as of end of April, what kind of testing that they went into, right? So India started at 142,000 and just went to 203,000. So testing didn't increase much. But if you look at same thing in global economies, the testing just ramped up significantly by 5 times, 10 times, and we were barely moved in terms of testing. So testing in India has been significantly lower, and that's been one of the pain points. We are not knowing how many of people are infected. They are moving around and spreading the virus further. So this has been a very, very peculiar problem with India. We are not even aware what kind of population has been impacted by COVID, and therefore how to kind of address that. So we are not looking at the right numbers per se to start with. Secondly, if you were to see what this lower testing translates into, lower number of cases, right? If you look at our, when the second wave started in end of April, we had 7,800 on a total cases per million people, we just went to 12,000. But if you look at the same number in global economies like France, Italy, Switzerland, UK, it just kind of multiplied. Why this happened? Because they were testing more people, and therefore they were getting more cases, and this is where they were address and catch that virus at that point and didn't allow it to spread. And that's the problem that India faced, that we were not testing, we were not knowing how many people were infected, and therefore our case counts were also lower as compared to the global countries. And because of, this was a very tragic way. We know someone within our families, within our relatives, within our friend circle who might have lost someone, right? But the statistics kind of reveal that it hasn't increased significantly. But if you look at the actual data, I think this number that we are seeing is far, far underreported. And if you were to look at the actual sequence, higher testing, higher cases, higher deaths, and that would translate into much higher numbers than we see these tall bars for other countries. So India had very massive, but the numbers that we are looking at in terms of official statistics are kind of underreported. So the wave was much, much severe than what the numbers that we look at. And one peculiar problem that again India was hit because we don't have adequate health infrastructure in place. If you look at hospital beds, if you look at number of doctors, if you look at number of nurses, we stand far lower than many other countries like even China, Sri Lanka, or even the developed markets like US, Germany, Japan. Our counts are much, much lower than even the world averages. World averages will have all kind of nations, the bigger nations and smaller nations, but our counts are not even half of the world averages. So we kind of lag significantly on all these things. And why is this the state? Because we are not spending enough towards healthcare infrastructure, right? If you look at India, spending towards total healthcare was just 3.6%, whereas other nations are spending much, much larger sums to get the health infrastructure in place. So if there is a third wave, again, we will kind of have a very tragic event because our healthcare is not up to mark. We haven't spent much, and therefore we are kind of bearing the aftermath of non-spending that amount adequately on healthcare. So this is a issue that we are staring at. And will this issue persist? Probably yes, because the kind of vaccination rollout that we have got to a very slow start, and we are still not, running towards vaccinating a lot of people. We have been, if the current statistics, if you were to look at it, India is close to around 3.5–4% of the total population vaccinated. Whereas if you look at the global economies like UK, US, what they did is they did a lockdown. They kind of used that lockdown to vaccinate a lot of people, and now they're opening up and not getting that waves again, right? India has a problem because we are doing a lockdown. We are not vaccinating enough people. And therefore, again, when we open up, the virus is still out there. So people will again catch the virus and it will spread. And as the new mutations keep happening, it will again be a further problem for all of us. So only way we see that, you can escape from this start, stop kind of pattern and a waves pattern is to vaccinate a lot of people. But we are not seeing a very good program being rolled out to ensure that most of the people get vaccinated. We have shortages of vaccine, and we don't know where those vaccines will come from. So that's a struggle, and therefore we'll have to live with that uncertainty that there could be probably a third wave, probably a fourth wave, and if you could go through this pattern of opening up, lockdown, right? So what are the scenarios that we're staring at? There are two things, right? Uncertainty related to COVID as COVID recedes, or COVID kind of still lingers and stays with us, right? What happens if COVID goes away? Probably the sequence that we see is central banks will stay accommodative for some time, but at the end of the day, they will kind of start tapering, pulling out some liquidity as they see growth coming back, as they see inflation rising. They will kind of, but initially it will, or if you're looking at a 1-year view or slightly broader, then at least equities will do well because there will be no uncertainty because of COVID. Debt may not do so well, but given that central banks will stay slightly more accommodative because global economy still needs support, gold may also do well. But overall, if COVID recedes, you will have a strong wave of spending against supporting equities. You will have better balance sheets because revenues and profitabilities of companies will grow. So you still have a good equity market, and you will kind of see inflation inch up. It's already inching up, but initially, as economies recover and there is pent-up demand rolling through, we might see that the corporates being able to pass on the inflation to consumers, and therefore, again, equities will be better in terms of profitability. So clearly, if COVID recedes, if there is no COVID, then equities is the place to be because of the growth that we will come over next 2–3 years, right? But second scenario, if COVID lingers, at the base case, that could be probably, given that we have a slow vaccine rollout, that could be a real certainty, right? So in that case, what happens is there will be a recessionary kind of conditions and less spending because incomes will be hit, businesses will be hit because of cost increasing. There is a fixed cost the business has to pay, and there are no revenues. Then again, equities have a problem. then equities have a problem because of those recessionary kind of conditions, low spending. But at the same time, central banks kind of remain accommodative that could help equities. Liquidity will lead to more asset price inflation, like what we have seen over the last 1 year. A lot of money printing by central banks has gone into assets, and therefore you see an equity market surge significantly world over. There will be higher government spending because there is COVID, and therefore there is a need for support to the economy. In that case, also equities may do well. But overall, the overwhelming situation of a recessionary kind of scenario may overpower all the other three positives. And therefore, if COVID lingers, then that uncertainty will lead to a decline in equity markets. And therefore, equities may not be relatively better as compared to debt and gold, because those are places which could do well if there is COVID around. So those are the scenarios that you need to keep into account before you take that call in terms of where you could position your portfolio and under what scenario, which asset class would do well. So what are the options you really have? Given that uncertainty is real, you need to make more money because there is inflation out there. So what do you do in such kind of scenario? One is to bank on stability. Currently, what we are seeing is that interest rates have declined significantly, right? We have seen interest rates fall significantly over the cycle, where we were looking at 8-9% FD rates, and we have come down to around 5% FD rates. So there has been a significant decline. Inflation has been inching higher. So on a real basis, you're losing much more. So FD kind of doesn't work for all of us, although it gives us assured returns. But at the same time, there are other risks, and also risk of falling returns that you get. And over long time periods also, if you see, FDs have been a losing proposition for investors and could be, given that surge of inflation that we see. One thing is certain, the spending that we all have to do towards our monthly expenses, our yearly expenditures, are going to stay here and keep increasing year on year, right? Like what a household a yearly expenditure in 1990s was close to 24,000 rupees. Today, the same consumption basket, the same kind of expenses like food, clothing, shelter, etc., is costing you around 4,27,000 rupees. So that has continuously increased and increased at a pace of 10.1%, right? Even between 2015 and 2020, this has increased by about 9% per year, right? So though the official inflation statistics were around 5% or below that, our real expenditure, the same basket that we kind of consume every year, has increased by about 9% even in last 5 years. If you look at things like gold, for example, it has risen nearly the same as compared to the inflation, slightly lower. But if gold prices were to inch higher, then I think it will catch up with that spending that we all have done. In terms of equities, it has far exceeded, the cost of consumption basket, that yearly expenses that we have, cost of inflation. And if you look at FDs, this FD basket, you would need 22 units of an FD basket to kind of meet your expenses. Today, you need 73 units. You need far more money if you were being in FDs to meet the same consumption basket. So it has, after taxes and up with a quarterly compounding, it has grown at just 6% per annum. So far lower. And if you were in FDs, you have really lost on a real basis. Though you got a surety in terms of returns, but that returns were not enough to even match the consumption basket or inflation in real sense. So does it mean that you should just move out of FDs and move into something like equities, which have done significantly better over years? No, that's not the case, right? Because equities are in terms have the highest risk, right? Though long term they do well, but they in any particular year, you could be ready for say a 40-50% fall, and you don't know when it can come, right? So you cannot put all your money in equities, because like what we saw in 2008 or what we saw in times of COVID, like in just 1 month, market fell by more than 40%. In 2008, it fell in that year by more than 50%. So those kind of falls or the risk of drawdowns are associated with equities, and therefore you cannot be in equities completely. You need to spread and it is very, very difficult to predict which is the next best asset class going forward, right? Why is it difficult? Because time and again, we have seen various dislocations in markets, some predictable, some non-predictable, some really very, very unexpected, like what happened in 9/11 or 2003 in SARS, or demonetization, or be it COVID. No one could predict these kind of events, right? There were other events which could be predictable if you were kind of putting your brains around what's happening over the global economy, how the macros are shaping up. You could predict many of these, but some are really unpredictable, and therefore you cannot be in equities because you don't know from which corner or the risk is coming from, right? But if you are looking at, say, equities, if you're impressed, this is return since 2004 till 2021, right? So if you were just looking at equities as an asset class, you would have got a return of around 12.5% in equities since 2004, right? But if you look at any point in time, what is the biggest fall that you would have got is 56%, right? Are you willing to kind of see that and sleep peacefully? That's the question you need to ask yourself. Are you worried about the 22% swing, the standard deviation that you see in the second row? Is the swing in returns? The returns can swing by 22% in any given year. So are you in terms with those kind of swings? If you're not, then you need to move into assets that kind of reduce your drawdown and reduce that mighty swings that you can get from a risky asset class. So if you were to add debt, you kind of get a slightly lower return, slightly better drawdowns, slightly better swings. But if you include 3 asset classes, and this is a portfolio of say 40 equities, 40 debt, and 20 gold, your returns, you do compromise about 1.5% or of returns, but at the same time, the drawdown from 56%, it reduces to 21%. And the swings, yearly swings in returns, of from 22% to just about 9.5%, right? So that is something that many investors will be able to live with, slightly lower returns, but better outcomes on the risk, right? This is what you need to do. You need to spread your assets into asset classes that give you this kind of predictability, a smoother rides in terms of your wealth creation journey, right? And if you were to use, even if those swings are higher, you could even tune your expectations by changing your mix in a way that you get more better smooth returns and more lesser downside risk, right? And you could be very, very dynamic with your allocation. So for example, this is what we have done with our multi-asset fund. The blue lines are our equity allocations, which could go from 25 to 65%. But if you see, we have never utilized, because in last 7-8 years, we have never got that opportunity or that wild swing in markets that we could really take it far higher to 60, 65%, right? And therefore, we kind of stayed conservative and kind of not taken that overt risk, but still generated a modest returns, right? So before COVID, valuations were still very high. We were at around 25, 26% allocation to equities. When COVID happened, markets fell by 40%. We got that opportunity. Valuations made sense. We kind of moved into equities. We increased our allocation from about 25% to more than 50%. And when again markets have rallied, we kind of have lowered our allocation gradually and booked profits. So this is how you can kind of get that smooth return journey, but at the same time use these opportunities to maximize the returns, right? And this is the track record. If you look at the scheme returns, 1 year, though, because the rally in equity markets over last 1 year has been very sharp, it's given a 16% return. So that kind of are aberration years. But over long time periods, 3 years, 5 years, 7 years since inception, it's been around 8.5%, 9.5%. So it's giving you better returns than your fixed deposits. At the same time, it has taken slightly higher risk to get that. So what is the kind of risk that it has taken? It has taken a standard deviation, a swinging factor of about 6%, has given you 9.5% return. So overall, it has kind of given you that steady return. If you look at the line, it doesn't swing so much, except the COVID episode where the fall was so sharp, but still the drawdowns was much lesser than equities. And the orange line that you see on the chart is your fixed deposit returns. It would have been going higher, but in a multi-asset fund, for about 90% of the time, you would have made better returns, right? And by taking slightly higher standard deviation, slightly higher swing. Even if you look at it on a 3-year rolling basis, each point on this chart is a 3-year return, right? And in a 3-year return, for about 85% of the time, you would have been better on a 3-year basis with a multi-asset fund as compared to your fixed deposit, right? So this really tells you that this really helps you. And if you look at any 3-year period, it has never given you a negative return, right? And the range has been around from 3% to about 2% in that range, roughly. And at most times, 85% of the time, it would have given you a better return than your fixed deposits. So these are the kind of things that you need to go into so that and move from a losing proposition, which is FD, because just it gives you assured returns, but those returns are not enough. You need to kind of move into instruments that kind of give you slightly better returns, and at the same time give you have a lower risk or slightly higher risk than a fixed deposit, but much lower than other asset classes. But one important thing that you need to keep into account is whenever you are choosing such kind of asset allocation fund to move out from your fixed deposits, you need to ensure that it is unbiased, dynamic, and agile. When I say unbiased is each of the asset classes should have an equal opportunity in a way so that the fund manager has a flexibility to move out of equities when it doesn't warrant that risk, right? Many of the products, similar products, have minimum 65% allocation to equities. Even if the fund manager doesn't like equity markets, is not comfortable with the valuation, still he, because of the mandate, is compelled to be in equities at a minimum 65%. Whereas the multi-asset fund that like the Quantum has, it can lower it to 25% and give you that protection when markets are kind of risky. So, and agile is the example that I gave you, right? When it was not warranting to take a higher risk, we didn't take that higher risk. When there was an opportunity because of COVID, we increased our allocation and reaped the benefits of the rebound. And now again, when markets have run up, we kind of have lowered our allocation because from a valuation perspective, they are kind of a little expensive. So our endeavor is to give you that better returns than your fixed deposit. At the same time, try to take minimal risk to get that return. Second thing, that was stability. So if you're looking at a conservative option and want better returns than a fixed deposit, then the multi-asset fund is a great place to be. If you want to be on the other side, the outcome could be that kind of COVID recedes and markets may do well, but still there will be an element of uncertainty. There you could bank on sustainability. So if you have heard of new form of funds called ESG funds, which stands for environmental, social, and governance, those are products that bank on sustainability of a company to drive that return. So when we all talk about quality companies and really good, steady businesses, these are those kind of businesses because they have a great company in terms of board management. They are foreseeing, they are aware of the risk. They kind of are looking at not only their businesses, but going beyond the traditional remit and looking at how they are, if their business impacting the environment or the society, and looking at all stakeholders together. For example, we all are aware of a company called Marico, right? Parachute, Hair Roll, Saffola, those are the brands that Marico has. If you were to look at Marico as a company, though from a governance perspective, it is very well-governed company. It has a professionally managed by a CEO, whereas the promoter holding is still very high. So that is kind of distinction between ownership and management of the company. Majority of the board members are truly independent. When I say truly independent, because many companies may have board members which are friends or distant relatives on the board. Do you think those boards are independent? Not likely, right? And if you look at the environmental traits of the company, 37% of the material is from renewable sources that they have. 93% of their packaging is recyclable. They have implemented responsible sourcing in their company operations. So overall, it is a good, sustainable company. And if you were to look at returns of Marico over time, long time frames, it has given better returns than what equity markets have given you, and even the likes of big FMCG companies like Hindustan Unilever, Dabur, Colgate have given. So sustainability delivers that long-term return and superior outperformance. At the same time, the risks are lower. Overall, whenever there is a company not looking at things like environment and social and as an irresponsible behavior, it kind of has in consequences, maybe in form of litigations, bad reputation, which will have impact on revenues of the company and therefore the profitability of the company. So overall, ESG companies kind of mitigate that risk, give you better returns. And why there is better returns? Because at some point in time, the profitability and sustainability kind of interlink. If you're not sustainable, then your profitability is kind of likely to get hit. And there is an Oxford study which kind of said that sustainable companies, when you look at these kind of companies, 90% of them have lower cost of capital, 88% have a higher operational performance, and 80% have a better share price performance. And it kind of flows into well into the logic, right? If you're a strong ESG company, you're looking at various things apart, not only at your business and business growth. It kind of makes you think, how can I be better? How can I be more competitive? And therefore, that drives the profitability. There is a better risk management because the company looks at various risks, not only at business or revenue risk, but also risk to the environment, to the society, in terms of taking good care of its employees. So there is a lower risk in such companies, and therefore such companies get capital or would probably get capital going forward at a lower cost, and therefore that will translate into a higher valuation. And we have seen time and again, if the company doesn't have kind of good practices, the street kind of punishes them very harshly and immediately, right? We have seen so many instances of bad, irresponsible behavior coming to light, and the stock prices react immediately. For example, in J&K Bank, there was issues surrounding their CSR funds. And when it came to light, the stock fell by about 20% in one day. You had Sun Pharma as a company where there were whistleblowers saying that there are financial irregularities, and when that came to light, the stock fell by about 26% in 2 months. 1% beverages, where kind of the auditor resigned, saying that they do not have enough information from the company. The stock fell by about 40% in 2 days. So time and again, we have seen various reasons, be it on the environment front, be it on the social, or be it on the governance front. Whenever there is a bad news on the company, the stock price will react like it has done for a long period. And we have seen that, we looked at a stock level, it works. We looked at the logic, it kind of makes sense. We look at indices, the ESG indices have done better than normal market cap weighted traditional stock market indexes like, say, Nifty 50 or BSE 200 or BSE 30 or the MSCI India index. The ESG indexes of MSCI and Nifty both have done better than the normal stock market indexes over long time periods. That tells you that ESG has worked, not from a company perspective, from an index perspective as well, right? And when you look at ESG, it's not only about risk, it's about identifying opportunities. So what really people call quality companies, right? What makes quality companies? I think these are the traits that make quality companies. You have good governance, you have good board, you have good management, you have good ethics. You are concerned about the environment and social externalities. So any company which usually doesn't have a positive societal impact in the long run will face issues in terms of its survivability or their business growth in the long run. So in companies, the corporate longevity that we are looking for will only be achieved if you have a positive societal impact. These companies are ready for the disruptive change because they are forcing, getting itself ready for the next stage of growth. They are kind of financially sound companies, and therefore overall these traits make them good businesses, quality businesses, And therefore, whenever the markets fall, these are the companies that are usually chased after by many fund managers. And if you're already in these companies, even during bad phases of market, they kind of fall lesser. That is what we saw also in our real track record that we have generated for the ESG fund, where not only in a short time frame, it has gone through a cycle. The fund was launched in July 2019. Post that, we had an upswing in the market. The market fell because of COVID significantly by more than 40%. And then there was a rebound in the market. It was a very, very sharp and significantly higher levels that we saw in markets that were prevailing before COVID. So the fund has done better than the ESG index and the BSC 30 index. And when the markets fell, the fund fell lesser as compared to these indexes. So it really tells you that it has helped protect value in a bad phase in terms of in a relative way, and overall over time period it has done far better than the normal stock market indexes, albeit the ESG index. So you have seen that ESG stocks do well, ESG indices do well, ESG funds do even better. So if you're looking at participating in equity markets, given the uncertainty out there, sustainability could be a good way to bank on, and even if there is a fall in markets, at least these probably will fall lesser as compared to the normal stock market indexes. So that is another way where you can participate in this stock market still, if you think that the risks are lesser, and you could just go and participate at least something in terms of your allocation towards equities. So with that, I think I will hand it over to my colleague Sorbh, who will take you through what are we seeing in equity markets. Is this resilience or is this complacency? What kind of trends are we observing? And whether you can bank on a manager to help you tide through this phase of uncertainty or not. So with that, over to you, Sorbh.
Thank you, Chirag, and thanks for giving us an update on how things are shaping on the COVID side. As Chirag said that on the equities, we thought it would be good to discuss why are equities where they are essentially, and there are a lot of questions on equities because the kind of tragedy that is unfolding in the country in form of second wave. Should Sensex be at the level where it is? And if yes, why? And if no, why isn't it falling? Right? So there are clearly two camps on equities, how people think about equities right now, Indian equities. One is whether the equities are resilient or people are or investors are complacent about the things going around in the country. So we'll talk about those things and what our belief is, on which camp are we on the equity side. On the first few slides, we definitely will talk about the valuations, we'll talk about the long-term opportunity, and we'll talk about long-term equity value fund and how our portfolio position in terms of this environment. So if you look at the next slide, which talks about the lockdown essentially. So if you compare to the lockdown in phase wave one, it was a very strict lockdown. It was covering entire country. Nobody could move, neither people nor goods, when it happened in March, April 2020. This second wave lockdown is very similar in the sense that just that it is a little localized in terms of it's driven by state governments. But if you look at from a pan-country perspective, almost entire country is some kind of restriction. Some of the states like Maharashtra, Rajasthan, parts of Haryana, Punjab, they are under strict lockdown. Some there are weekend curfews. So there is a sense of lockdown that is prevailing across the country. The only difference being that this time the stringency of the lockdown is a lot less. So learning from previous lockdowns, the government has ensured that there is a movement of goods. Exporting companies can export, essential product companies can produce and transport goods. Similarly, essential people who need essential things can go out and buy them. So they have tried to manage livelihood better this time. Last time focus was on lives. This time the focus was balancing lives and livelihood. Unfortunately, because of that, lives have been lost a little more, and which is very, very tragic. From an equity market perspective, as Chirag highlighted, this is a big tragedy. Number of people reportedly who are dying are 4,000, and many media reports suggest that actual deaths could be multiplier of that, then why are markets not falling? So market tries to differentiate between tragedy and statistics. Right? So tragedy, yes, it is a tragedy, but is it statistically important for corporate profitability? Is that those numbers and 1.3 billion statistically important for markets so that the future profitability starts to get impacted? So market is in that sense a little more rational compared to individuals. That is the one reason why markets are not reacting the way it should be reacting. That's the first part. And second, when Chirag alluded to more about vaccination, so markets this time, unlike previous time, knows what the end game is right now. Unless there is a mutant variant which tells you that no, the vaccines won't work. We know this time that the max vaccines are going to work. There are vaccines. It might get delayed, but it will work. So market is in the camp that, okay, vaccines will come sooner or later, and things will be, things will be okay, and the growth trajectory should continue. So that is the market right now is in that camp. As far as corporates are concerned, corporates have also become much more sensible. Corporates have focused on their balance sheet quality. Corporates have focused on their costs. So if you look at costs have come down, they focused on not expanding costs. They're not doing a lot of capital expenditure. They have strengthened their balance sheets. Last 6-9 months, most of the companies who were in some kind of debt or leverage have raised capital because liquidity was there in capital markets. So they've used that if you look at private banks and NBFCs, and banks and NBFCs is a leveraged business where you have capital and you leverage on that. Almost all of the private banks and NBFCs have raised capital in the first 2 or 3 quarters of FY21. So if you look at their capital adequacy, it's one of the strongest in last 10 years. So that makes an investor a little less worried about the future of these companies, and they have been providing a lot in terms of provision for COVID for bad loans. So that is also sitting in their books. So that is also an additional comfort. One more important point is that this time COVID related issues are more India specific. It's not a global problem because globally developed countries have managed to resolve that problem. So UK, if you see, is close to 50-60% vaccinated. Israel is vaccinated at a quite high level. US is vaccinated at a very high level, 30-35-40%, and vaccination going on quickly. So their economy is rebounding. This means that global economy and global stock markets are doing okay. From an Indian perspective, export-oriented companies and commodity companies tend to benefit when global economy at least is doing well. So that part of the market is also doing pretty well. So those are some of the reasons why we believe that there is a strength in the market. And clearly, from here on, how bad this COVID thing can become and can it impact the corporate profitability will be an issue that needs to be asked. And we'll just delve a little more about the internals of equity markets, about how markets or companies have behaved in terms of profitability, and that will give us some more color on how it is happening and how things are happening within the corporate world. Yeah. So if you look at corporate India, listed companies are faring much better. So I'll start with the right-hand side chart. If you look at those red bars since March 2006 till December 2020, quarterly profits in rupees billions, it's very, very unusual to see that the COVID impacted quarter of December 2020, which was the third quarter, has the highest profitability of listed companies in India. Now, what drove that is, we'll come to that in terms of how cost cutting happened and how they drove profitability. But clearly, the listed companies are doing much better. We know that SMEs are struggling, a lot of people are losing jobs, but large listed companies are doing much better. Their profitabilities are back in shape and much stronger than history. And that is getting reflected partially in the stock markets. Left-hand side slide, if you see, smaller companies are deeper in red. So the first chart that you see within the right-hand side chart is the net sales of listed non-finance companies in the third quarter and a YOY change. And this we have divided into 10 companies. So if there are total 100 companies, top 10 companies have seen 0% YOY growth in sales. The next 10 companies of the 100, if you assume there are 100 companies in India listed, they have grown at 5% in terms of revenue, but the last 10, the smallest of those, the D10, they have lost 60% of their sales. So clearly, the larger companies have their business much stronger. They have scale, they have stronger balance sheet, they are managing things much better. They have much more distributed sales geographies, they export, and that's the reason they are doing much better. The next chart within that same right-hand side chart, if you see how their wage bill has gone up, has moved in the last quarter. If you look at the top 10% of the companies, top 10 percentile of the companies, their wage bill has gone up. So people working in the larger companies, their salaries have actually gone up. At least the spend on the salaries for those companies have gone up. The last 10% of the companies, if you assume that the total number of companies listed in India is 100, that has gone down by 30%. So smaller companies' sales suffered. And as a result of that, they have cut down on salary costs. Either people have seen cuts in salaries at those levels, or they have seen loss of jobs because of that. So clearly, big is getting bigger and small is getting smaller. This is the trend that is getting exacerbated because of this whole COVID-induced pandemic and lockdowns. Again, to further strengthen our point, if you look at the sales growth, now this blue line on the left-hand side chart, if you see, is the top 30% of the companies, and this is listed, unlisted both, right? So in June 2010, the top 30% of Indian companies were growing at 20%, and the last 30% of Indian companies were growing at 10%. So the difference was closer to 10% between the growth rates. Come December 2020 until December 22, we have seen demonetization, we have seen a quick implementation of GST, we have seen lockdown 1, we have seen IL&FS, a lot of things have happened. What has it done to corporate India? In December 2020, the top 30% companies have grown at 0% or maybe 2% YOY. The last 30% of the company, which are the smaller companies closer to SMEs, have degrown by minus 40%. So the gap is now 40%. Essentially, the large is getting larger, and the listed space represents those large companies. The Sensex represents larger companies. And that is the reason you're seeing that they are getting stronger. And that's the reason why index moves up continuously. Come to the next slide. Within this slide, if you see the right-hand side chart, fixed asset formation. So companies invest and then they can produce and they can sell, right? That's the way it is. So in September 2010, fixed asset growth, which is the capex that these companies were doing, blue line, top 30%, was growing at 10%. Now it is growing at closer to 2-3%. But if you look at the bottom 30% companies, since March 2013, there is a degrowth in their fixed assets. So they are not investing in fixed assets. Their revenues are not growing. So they are in that kind of loop where they are getting smaller, they're getting crunched, and they're facing a lot of difficulties and bankruptcies. And equity markets, Nifty 50 represents those larger companies which are doing relatively well, gaining market shares, and that is getting reflected in equity markets. So if you look at the longer term chart, now we took this from September 2005. Essentially, that was the start of that brick mania rally, and till date, March 2021, the saffron line that you see is clearly outperformed the mid cap and the small cap. The saffron line represents Sensex because larger companies are getting larger, they are getting more profitable. Essentially, contrary to belief, if you look at a longer time horizons, the larger companies tend to do well than smaller companies. And we are here talking about only passive kind of investments in indexes. Active managers could do better in choosing companies, but that also will increasingly become difficult if this trend continues. So this is the valuation band that we are looking at. So valuations maximum reached at 43 times. So Sensex, it's now cooled off to 37 times. Still very, very expensive if you look at purely from this charts perspective. But one thing we must understand in both these charts for BSE 30 and BSE mid cap is that first quarter of last year, that was the June quarter for FY21, there was strict lockdown and most companies did not sell anything and they have very low profitability. So that earnings is shrink, and based on that shrinked earnings, you are seeing the valuations spike up. Right? If you normalize that, if you take a normalized 4-quarter earnings for Sensex and mid-cap, these valuations will look a little more comfortable, though still expensive. So average is close to 20.6 since 2001, last 20 years average for Sensex. It will be quoting at normalized earning, it will be quoting at 23 times. Similarly with mid-cap index. So broad understanding on complacency and resilience that we were talking about at the start of the equities presentation, we clearly believe that in terms of resilience, large companies' business models are much more resilient. So they will be resilient, they will be able to survive this cycle and should be okay. We believe, at least from a valuation perspective, there is a sense of complacency coming. Some of the large caps and a large part of the mid and small cap, where they are the big sufferer of this kind of lockdowns, the valuation seems to suggest that there is sense of complacency that is getting into this mid and small cap investing. So one has to be careful. So that is our understanding of how things are shaping up. And as Chirag told, that this is a very evolving scenario, how vaccines take shape and how third wave happens. That's how we need to look at things if you look at the near term. Now we'll talk about earnings growth. So this is the consensus earning charts. So even before the COVID struck, we had seen that the earnings growth was not happening in India. And this is right from 2016, when initially we thought earnings growth cycle will pick up, but then demonetization happened, post that island of GST implementation happened, post that island FS happened. If you look at across these lines, and these are consensus EPS estimates of different sell side aggregated by Bloomberg, you see every year the estimates will keep on falling. And for FY21, because of that strict lockdown, it fell off very, very sharply. The blue line that you see, FY21, it just fell off the cliff. Similar for FY22 also. Since then, we have seen some bout of earning upgrades. It just bottomed out and then started to move up. If you look at the right-hand side, fair right-hand side of this chart, for FY21, FY22, and FY23 has been flat. So there has been some round of earnings upgrade, because since the lockdown opened, profitabilities of the companies improved, the sales started to happen, and there was kind of pent-up demand. So earning upgrades started to happen. What drove these earning upgrades is important. So if you look at this table, the second table, I'll talk about the second table, EBITDA margins. So we took BSE 100 companies, out of which 20 companies were financial companies. So we pulled them out because they don't have EBITDA margins, they have NIMs and other things. So of the 80 companies of the BSE 100, in Q1, which was the June quarter, out of 80 companies, 27 companies saw improvement in profitability, margins, is what you say as margins. In Q2, that number improved to 60 companies, right? Out of 80, 60 companies saw EBITDA margin improvement because they were controlling cost very sharply, and the demand came back, and that benefited in terms of very sharply their EBITDA margins. Similarly, in third quarter, out of 80 companies, 58 reported an improvement in margin. In fourth quarter, 28 companies have reported, out of which 20 companies have reported improvement in margins. Right. So this whole earning upgrade has come not from revenue growth, largely it's come from profit expansion, because you controlled cost, demand came back, and that resulted in sharp improvement profitability. From here on, the revenue growth has to come back, because there is a limit to you can squeeze your costs to increase your profitability. Ultimately, revenue growth has to come back, and that should derive your earning growth. So for a sustainable earnings upgrade cycle, which should result in a good performance by equity markets. So till Feb, we were also feeling quite comfortable in the sense that this cycle is in place, the interest rates are low, people are investing, housing sales have started to improve. So this cycle will take shape with earnings upgrade cycle. But last 1.5 months, with these few lockdowns that have happened, there seems to be a little worry. Though we have tweaked our numbers, but this is something which is in a flux. So we have to be very careful what happens in next 3-6 months to take a call in the near term. But we should also not lose focus on the long term. Right? So long term, it's very important to believe in that the world will continue to move on. And more important for any investor is that wherever you are investing, in whichever country you are investing, that the country will continue to move on. There will be a certain level of growth and things improve over time. So that is the basic platform on which equity investment is built, right? So long term, we have to be believing that India can grow at 6.5%. There will be second wave, there could be third wave. There is a history of prime ministers getting assassinated in India in last 40 years. We have seen opposition leaders getting assassinated. We have seen different parties forming different governments. But over the last 40 years, India has managed to grow 6.5%. And we believe that thesis will continue. And there could be second wave, there could be delays in vaccinations. But ultimately, we need to believe on that India story. And we need to believe that in India, there would be entrepreneurial spirit who will continue to invest in companies, factories. There will be consumption by people like us. There will be people buying houses. People will be buying houses, two-wheelers, four-wheelers. And that will result in that 6.5% growth. And basis that your equity allocations should be there for long term, so that you continue to benefit from 6.5% economic real GDP growth rate and a 4-5% inflation, which gives you closer to 11 to 12% nominal GDP growth rate. Good companies could gain market shares, so they could grow at 13-14%, and active manager who can pick up good businesses at good valuations can give you easily 14 to 15% rate of return over long periods of time. So that story is intact. So this pandemic, no pandemic, should not deter you from allocating your equity from a longer term perspective. Now, what worries us the most, near-term pandemic or anything that has happened? Long-term, we are quite constructive on India's story, and one should be investing into equities. What worries us the most is the jobs and the income, and that's the biggest problem. And that's not a new problem in India. Now, last 4 or 5 years since the GDP started to slow down, the job creation has not happened in India, and with a lot of young population coming into the job market, this we need to do. So these two charts highlight what happened when this whole strict lockdown happened last year. So in the first left chart that you see, people employed in salaried jobs since March 20 came down very sharply, and people employed in agriculture, which is a seasonal labor, which is the light pink line, moved up, right? So people, India needs to create those steady salaried job, so that people can consume, which is called a formal job sector, right? So that needs to be created on a steady state. And this start, stop that Chirag talked about, that will be a big impediment for this kind of job creation, white collar job creation, if I can say so. And if that happens, then this India story gets derailed for 1 or 2 or 3 years. So this is something extremely important, and everyone should keep a very close watch while investing, that this problem is taken care of, and this start, stop, and economy does not happen. Because if it damages structurally in terms of some of the larger companies start to get impacted, to generate employment, then it shall be a problem for this whole consumption theme, and the medium term will look a little more blurred. So we'll talk about quantum long-term equity value product, which is our flagship equity product, actively managed. Chirag, in his sustainability presentation, talked about ESG, which was the environmental and social governance, the product which we launched in 2019. Out of that, the governance aspect is something which Quantum believes since 1990, since its inception in early 1990s. And in 2006, when this retail product, Quantum Long-Term Equity Value product was launched, it was a combination of a liquid product, in the sense that liquid stocks filtered for governance and filtered for governance and taking valuation, taking value style under consideration, taking a margin of safety, trying to create a portfolio of 25 to 50 stocks for long-term investments. And this would be across sectors, and the sectors are tracked by different analysts who look at different sectors, arrive at a buy and sell, and based upon margin of safety and value style, we create a portfolio of 25 to 40 stocks. The track record is good, 15 years old now. So very disciplined and research and investment process in multiple part to profits, both when we were able to interact physically and also over EPTPs. We have discussed those, and in the future also we will be discussing those more often about how this process works. we invest in companies, hold for long. The view is to invest for at least for 2 years. So the portfolio turnovers are less. So in terms of costs are low. Either the portfolio will have shares or will have cash, will not deploy any hedging strategies over that. And it's a well-balanced portfolio of 25 to 50 stocks. And it's a good product to own for your long-term retirement goals like child's education, child's marriage, and wealth creation. So equity generally is good when you're investing at least for 3 years. And more longer the term, more you get the compounding benefit. And this product is designed to such a way that it benefits over long term and keeps capital protection in mind. So tries to minimize the risks of capital erosion or permanent loss of capital while looking at capital appreciation for your long-term financial goals. Now, let me talk about this, how, as of now, our portfolio is structured. I've given you how things could move. Things are in a state of flux, and Chirag also highlighted that there are two scenarios, basically. Third wave comes and COVID situation gets worse, or there is a situation where vaccination happens quickly and economy is on the recovery track. So a few things that we are understanding on the economy is that the winter crop, the Rabi crop, has been very, very good. Commodity prices are good. So the farmers and the rural economy should do well. And the prediction for next year's monsoon, third in a row, is expected to be a normal monsoon. So some of our portfolio stocks are geared to benefit from that good rural economy, which is continuing for last 2 years. Hopefully this year also it will continue. So some of the portfolio stocks are geared to benefit out of that. Last year, when the markets fell, we got opportunities to get into some very good market leaders in their respective sectors at good valuations. So those stocks have done well. We continue to hold them. They are long-term stories. And since valuation became attractive, we got into them. So one was a good name in IT that we got into. Then one of the market leader in premium motorcycle, we bought that stock. One of the leaders in banking, private sector banking, we bought that stock. One in capital markets. So we continue to hold them in the portfolio. They have good, strong balance sheets, very strong ROE, very strong market positioning in their respective sectors. We have higher weights in cyclicals like NBFC and consumer discretionary, because in the start of an economic recovery, cyclicals tend to do better than defensives. So our portfolio is aligned towards that, because the valuations were attractive of cyclicals about a year ago, and prior to that, our positioning is towards cyclicals, which are benefiting from that cyclical recovery. So net, our portfolio is attuned to benefit from our cyclical recovery in the economy. But at the same time, we have been stress testing our portfolio in terms of their balance sheet strength and ability to survive if there is a deeper crisis. So we have doing that stress test. So at the same time, we are ensuring that our portfolio has minimum risk of permanent loss of capital, if I can say so, if things go worse. So there is a lot of stress tests that we are doing on our company's balance sheet and other things. We have close to 6.5% cash in the portfolio. And if markets were to correct, we'll be using those cash to get into some good names in the portfolio. So summarizing, there's a two scenario which Chirag also highlighted. There is a boom scenario if this second wave gets arrested quickly and there is vaccination quickly. Real economic activity should revive very quickly, and earnings upgrade should continue to happen. A real estate revival, which was happening because of stamp duty cuts and lower interest rates, if it can continue to spur real estate demand, then it benefits the whole economy. Factories reallocate from China to India because of PLI and MNCs diversifying their manufacturing base, that should benefit India in the long term. And foreign flows, because nominal interest rates in India are high, nominal GDP growth is high. We should continue to get fair flow of FDI and FI flows. First is poor government policy. Now that is a joker in the pack, right? And that is something which we always fear about. So that can be a negative. Resurgence in COVID cases already starting to play out, and poor execution of vaccine rollout. Now, our expectation is that they should get arrested because the government in India works best when their back is behind on the wall. So they are now feeling the heat, and things have gone out of their hand. They're now working overtime to get those vaccines, 2 billion vaccines by December. And if that works, things should improve back again. And rising inflation, Chirag touched upon that. Rising inflation could lead to a sharp reversal in interest rates, and that could impact the economic recovery and your equity returns. Chirag has already touched upon the asset allocation strategy, so I'll not spend time over there. Over to Reina, she'd like to talk a little more about Smile initiative from Quantum. Thank you.
Yes. Thank you, Chirag and Sorbh, for that very insightful presentation. Before jumping into the Q&A session, I quickly want to introduce the Smile facility to all of you, an initiative between Quantum Mutual Fund and Help Your NGO. This facility enables an investor, on the basis of their consent, to contribute some percentage of their investment with Quantum Mutual Fund towards a charitable cause to any NGO that's registered with the Help Your NGO Foundation. To know more about this, visit our website and check out our FAQs on Smile or reach out to customer care. Now we'll begin the Q&A session. We've already received a lot of questions, but if you have any remaining, please do send it through the chat box. So the first question is for you, Sorbh. The stock market has been extremely volatile in the recent past. Do you see a correction happening soon? And what will be a good entry point level with regards to the current PE for Nifty?
Yeah, thank you, Raina. Yes, markets have been volatile, and now clearly, as of now, market, if you look at the PEs and general expectation, it looks like the market seems to factoring in that there will be vaccination delayed or at least in some time, and economic recovery will be intact. So things will continue to improve. Quarterly profits of corporates will continue to improve. As of now, market seems to be believing that story. And if there is a little disturbance in that story, markets will correct sharply. That's for sure. So the second scenario that Chirag painted, if that starts to play out, where we see quick third wave coming and still there is no vaccines around and still more stringent lockdown, market will correct sharply. It will be difficult to give Nifty levels and P multiples. What I understand is that currently it's more than fair value, the Nifty P. And so looking at Nifty P investing would not be a great idea, because as a team, we also feel that broader markets is giving a lot more opportunity. There are pockets of valuation where we find comfort, because Nifty represent companies which are kind of very skewed. So if you look at top 3 or 4 companies in Nifty represents 30-40% of the weight. So Nifty P will be a factor of those 3-4 companies. So it's not a great idea to look at Nifty P multiples. But yes, the average has been 20 for in terms of P multiple. Then it becomes individual's comfort at what discount you want to buy Nifty at. As of now, it's at a slight premium to that average if you normalize the earnings.
Thanks, Sorbh. So Chirag, next question for you. In wake of the second wave of COVID, according to you, which style of investing works better, value or growth?
So in terms of the wave of COVID and the resulting uncertainty that we have, I think it will be better to go with a value style overall, because there is a margin of safety, there is a cushion built in terms of looking at stocks. And also if there is uncertainty lingering, the fund manager and their teams will kind of be fast to incorporate that and take those decisions out there. Whereas from a growth perspective, it will still look a larger growth or post the episode or post the uncertainty environment that we are looking at. So overall, in this kind of scenario, I think it will be better. But overall, I will urge investors that to maintain an asset allocation. You will not be able to, buy it at the best time or sell it at the best time. It is always seen that the good news and good prices don't come together, and therefore, it will always be better to maintain your spread of assets. And within that, if you were to look at a particular style right now, I think the 2 of the styles that we presented, one is the value style, which will kind of take care of the uncertainty that kind of erupts. And secondly, you can bank on sustainability, because those quality companies at the end of the day will kind of get to you. And in uncertainty, we have always seen that quality is much chased after in market, and therefore it will also act as some kind of cushion towards the fall that we may see in the uncertain environment. This is kind of a better way to kind of go about it. Asset allocation, and within the equity allocation, you could look at value and sustainability as the 2 pillars of your allocation.
Great. So Sorbh, which are the more prominent sectors to invest in at a time like this? And are you looking to include more FMCG and pharma sector stocks in your portfolio?
Yeah, so as we said, when we are looking at an economic recovery, a good portfolio should have cyclicals in them because cyclicals tend to benefit from that economic recovery, and that's how we have also positioned our portfolio, believing that that economic recovery will continue after this kind of pause of the second wave. So cyclicals, especially on the banking side or consumer discretionary side. So these are the names where, as economic recovery happens, the demand for these things improve, and they see earnings upgrade much faster than defensives, which you talked about, FMCG and pharma. So those are the sectors which are expected to do a little better. In terms of pharma and FMCG, since we look at all those sectors as well, the only hitch, pharma, we do own two of the stocks and we got them at good, decent valuations, and then they have done well for us. On the FMCG side, the only challenge that we are facing is the valuations. So valuations don't seem to correct. They're trading at 70, 80 times. And at 70, 80 times, we don't believe any of the sectors can be defensive from a portfolio perspective. So FMCG, the challenge is valuations, and we do assign a certain premium because of the quality of companies, quality of cash flows, and brand of these companies that they own. But even after assigning a premium to those effects, the stocks do not come into buy. So we'll be waiting if a decent correction happens. We'll definitely buy into FMCG.
Thanks. Chirag, which is the best avenue to park your liquid money? Is it an FD, quantum multi-asset fund of funds, or other liquid funds, and why?
Yeah, sure. I think to park your liquid money, it depends on what is the time frame that you're looking for. Like many people, we have seen that they do a 1-year FD and keep rolling over for 3, 5, 7 years. That's a typical investment style that we have seen because they don't want that uncertainty in terms of, if I need money 1 year down the line, what do I do? So to take care of that, people kind of do a 1-year FD and keep rolling it over at the end of maturity. So if your time frame is a little larger, then I will suggest that you kind of move into assets like multi-asset. I think that tend to give you a better return than your fixed deposits. At the same time, you end up taking a slightly higher risk, but I think it's more commensurate with the returns that you get because of the risk that you're taking. So, so overall, I think if you're looking at a 3-year plus horizon, one is it is better returns that we have seen over the time frame that we have witnessed. It has never given a negative return on a 3-year period basis. And thirdly, it is very, very tax efficient as compared to your fixed deposits. So if you're in a 30% bracket, then your FDs are significantly lesser return from a return perspective. They give you very less returns because tax eats up a lot of returns that you generate from a fixed deposit. So if you're earning, say, 5-6% on your fixed deposit, eventually, because of the 30% tax, it erodes like somewhere around 150 basis points of returns that you get. So eventually, your net will be around 3.5-4%. Whereas if you look at multi-asset, over a 3-year period basis, they kind of taxed with 20% with indexation over the 3-year period, which means that your effective tax will be somewhere in the zone of 8-12%. So that is significantly lesser tax, and only when you book gains, you pay that tax. Also, when we shift allocation from one asset to the other, there is no tax element that goes out because of that rebalancing. So there is no tax element. If you're doing it on your own, you have to pay each time the tax when you're switching from equity to debt, debt to equity, or to gold. Each time you pay a tax, whereas a mutual fund is far tax efficient because you don't end up paying tax when you make that switches. So if your horizon is very short term, then fixed deposits, liquid funds are a better avenues. And if you're looking at a slightly longer horizon, at the same time, they are very, very liquid. Even if you need money after 1 year, you get money from the multi-asset anytime you want. So it is very, very liquid. But if you think that there is uncertainty, but still your horizon is kind of a little long term, and if there is a need, I can get the money, then I think multi-assets are a far better avenue as compared to your fixed deposits.
Thanks, Chirag. So we've gotten about 3 or 4 questions related to the QMAF and FD. So I'm just going to address all of them to you one after the other because they're a little interrelated. So are there any regulatory asset class minimum weightages given to the quantum multi-asset fund of funds?
So regulations give a framework, but that frameworks are usually very broad. What governs one fund's allocation is what's referred in their mandates in terms of their offer documents. So if you look at the quantum multi-asset fund, for example, equity and debt allocation ranges are from 25% minimum to 65% maximum. And for gold, it is 10% minimum to 20% maximum. So I think each fund, depending on where they classify it, they can choose within a broad framework what kind of allocation ranges they will have. So regulations do prescribe, but I think they are very, very broad. And within that, the fund is free to choose what mandate they want to run to. Why we selected 2565? Because our endeavor was to give you better returns than your fixed deposit and take minimal risk, to be kind of a little conservative in our approach, take risk only when there warrants to, and otherwise refrain from taking risk and reduce risk from that perspective. So our ranges are as per 2565 equity debt and 10 and 20 gold. So this is how you'll have to look into each fund's own mandates, how they have designed the fund.
Okay. So the next question was actually what the QMAF equity allocation is. You've already given the range. So you can just elaborate on the expense ratio of the fund, the exit load of the fund, and the rolling returns of the fund.
Sure, absolutely. So if you look at the expense ratio is because given it is a fund of fund, for equity, we kind of take exposure to the quantum Nifty ETF, the quantum long-term equity fund, and the quantum ESG fund. Those fill up our equity bucket. For debt, we kind of use the quantum liquid fund and quantum dynamic bond fund to make up our debt allocation. And for gold, we use our quantum gold ETF to make our allocation. So the expense ratio is what kind of allocation we have in the underlying products. And that will tell you that what is the expense ratio overall net to the investor. The quantum multi-asset fund on its own charges 0.1% for all the allocation work, all the rebalancing, all the tracking that does for investors. And secondly, the blended expense ratio, including the 10 basis points that multi-asset charges, including that of the underlying funds, today stands at 0.57%. So it's a significantly low cost product, and usually it will range between 0.5 to 0.7% in that range. And currently it stands at 0.57%. Depending on our allocation, it will kind of move up and down, but it will broadly retain a range of 0.5 to 0.7%. And thirdly, on the exit load, there is exit load only up to 3 months. That is 1% up to 3 months. Any holding you have more than 3 months, there is no exit load that the investor pays. So it is for a very short duration that we have.
And can you also touch upon the returns for the multi-asset fund?
Absolutely. So we've seen that what we have tried consciously doing is to give you a return that is, very consistent, not really volatile, and give you better returns than your fixed deposit. And I think in that endeavor that we have had, I think it's been successful at that what we wanted to achieve. Right? If you look at barring the 1 year period where equities have rallied and therefore the gains are much higher at 16% returns, but over a longer time frames like 5, 7 since inception years, it is very, very steady. If you look at it's 9% plus, 9.2 to 9.5% range, and it is better than what your fixed deposits would have given you, and at the same time being tax efficient. So long-term returns are much, much steadier, much, much consistent. And if you look at the rolling returns, which was the question, this is each point on this graph, each point makes up a 3-year rolling return. So if you look at 3-year rolling return, have been in a range of say 2% to 13%. It's been in that range. Never on a 3-year basis, it's gone into a negative territory. So from a capital protection perspective, also, or if your horizon is 3 years, it has protected capital. And at the same time, at most times, that is 85% of the time or 84% of the time, it has given you better returns on a 3-year basis than your fixed deposits. So overall, if you look at it from a package perspective, you have a higher chance of getting a better return than your fixed deposits, a lower chance of losing any money. And at the same time, it's been very, very consistent. Like you saw that longer term returns 5, 7, and since inception.
Right. Thank you. So if an investor was to invest in the quantum multi-asset fund of funds, do you recommend that they invest in one go via lump sum in the prevailing market conditions? Or do you think that staggered investments over 3 to 6 months would be a better idea?
I think when you're investing in a multi-asset fund, you're relying on the fund manager that at each stage, they will reduce risk when it warrants. And at the same time, they will capture all the opportunities that come by, right? And in that endeavor, they will get you optimal returns and at the same time take lower risk. That is what you're banking on that fund manager to do. And given that the fund manager needs to be agile, you never know when the opportunity arises. Like for in the month of March itself, last year, 2020, because of COVID, there was a sharp fall in equities. We kind of increased our allocation from 25% to 50%. We don't know when these kind of episodes come and go, and the fund manager positions itself to kind of optimally get you returns. I think a lump sum investment makes more sense in the multi-asset fund because the fund manager is working hard for you to ensure that you kind of optimize your returns and take lower risk. So a lump sum will be more a recommended option as compared to an SIP in a multi-asset kind of fund.
Thanks, Chirag, for all the multi-asset answers. Next question is for you, Sorbh. The QLTEVF claims to protect an investor's downside risk. Can you elaborate how this is managed with the current market cycle successfully?
Yeah, so I'll just discuss a few points on the process, how it works. And from a statistics perspective, you can look at the Sharpe ratio, long-term Sharpe ratio of the fund. But the problem with the Sharpe ratio is that it takes standard deviation, and standard deviation can be both on the positive side and on the negative side. So you can do that in terms of volatility vis-a-vis the benchmark. That will give you some answer over there. But from a process perspective, how the fund operates is that since within our research process, we have a buy and sell on every stock. So whenever we buy into a stock into the portfolio, we do it generally at the buy level or at below the buy level. And if stocks continue to move up after we have bought and it reaches closer to sell level, and that generally happens when the market becomes really frothy and the valuations move up, we have to trim the stocks because it's reaching its sell. So what happens is that when markets fall very sharply, the way it happened in March 2020, we saw a lot of good names coming into the portfolio. We had quite a bit of cash, closer to 11% cash in February 2020, and that we managed to deploy that in March and April. And then stocks started to do well. And because of earning upgrades, we've not seen that kind of trim that would have happened the way market rallied, because the earnings have also gone up. If the earnings don't move up, the stocks will start to hit sell level and we'll trim that stock. So because we trim at 40 levels of the market, because the stocks have moved up, we create cash in the portfolio, and that's where we try to protect the downside. That is purely from a volatility perspective. Our main approach here is to minimize the permanent loss of capital that can happen in the portfolio. And through our research and stress testing, we ensure that we don't get into a stock or minimize the chances of getting into a stock where we have a tangible loss in that stock in the portfolio over long periods of time. So these are the two ways we try to protect the downside in the portfolio.
Okay. So one more question regarding the QLTEVF. Will quantum increase allocation to PSU companies, excluding power and refineries, which are already part of the portfolio, as they are available at multi-year low valuations?
Yes, so we have been carrying PSUs for quite some time. As rightly said, one power name and one names, oil and gas names. Now, PSUs we also like. They have a good business model, and even if you factor some bit of inefficiency because they have a mandate from the government, also still they are attractively valued. They have good, strong dividend yields. We continue to hold. The only thing which we did not like over the last 3 years is that government selling their stakes at arbitrary prices in the open markets through ETFs. And some of the decisions of the government of selling stakes to other PSU companies to that has dented the shareholder value creation. So we are a little worried over that. Over the last 3-6 months, the finance ministry and the government has come out and said that henceforth the selling of PSU stakes will happen through strategic sale only. If the government continues to believe that and it does that actually, then our confidence on PSU will increase. If that does not happen and it continues to sell through ETFs and at discount rates and do this kind of stuff wherein one stake in the PSU of the government is sold to another PSU and the cash is taken out by the government, if those things continue, we will be capping our stake in the PSU kind of PSU companies. So we'll be looking at that. It's a good step by the government that they plan to sell PSUs now only through strategic disinvestment, non through small stake sales at discount in the markets. So that will be heartening, but we'll give it some more time. And if we believe that the government is walking the talk, then only we'll look at increasing buying into PSUs.
Thanks, Saurabh. So Chirag, what is the gold outlook for 2021 with regards to the US dollar and the Indian economic as well as stock market recovery?
Sure, okay. So gold, I think when prices fell over the last couple of months because of the optimism regarding global growth recovery, I think it's kind of stretched more to the downside. So it kind of fell below because money supply has been increasing and gold at the end of the day is money, and therefore it kind of fell below that line and kind of became undervalued. Now it is catching up, coming back to the same money supply line and become kind of fair value when it kind of moves higher. So overall, from a dollar perspective, I think dollar has been weakening, and I think it will probably weaken going forward. If you look at the deficits that the US government is running, and even in good times or at least over the next few years also, their own CBO estimates say that they will at least have $1 trillion deficits each year over next few years. So they will run high deficits, the kind of spending that they're doing towards infrastructure and stuff. I think it is significantly large. So they will continue to run deficits. Their debt has increased significantly. Their interest expense, if yields move up, will also be a bigger burden for them. So overall, fundamentally, US dollar looks like on a weak footing. Only thing that they can help, what can help them is if there is significantly higher recovery in the US and other places don't pick up pace, then there could be flows that move to the US market, given that they would be the ones growing faster. But if that doesn't happen, overall, we see that US dollar will keep sliding over the next couple of years at least. So from a dollar perspective, I think gold is better poised. Second factor that moves gold prices is real interest rates. So if you see interest rates, according to us, will likely remain lower for a fairly long time. If you look at the 2008 crisis, interest rates stayed low to the zero level for 6 years. This was a far bigger crisis that we saw, and therefore rates are likely to remain or pivoted to a much lower level. Central banks will continue to print more money. So from a real interest rate perspective, there is higher risk of inflation. We're already seeing commodity prices in multi-year highs, like for example, agri-commodities, or be it metals are ruling at multi-year highs. There is a bout of inflation out there, which looks like more sticky in nature. And from a real interest rate perspective, interest rate low, inflation high will lead to real interest rates staying lower or negative as we are seeing it now. So that is one of the biggest drivers. The big rallies that we saw in gold, be it in the 1970s or after 2008, were in times when we had negative real interest rates, which is likely to remain. And therefore, we are constructive on gold. Gold prices should do well, given these factors that we are seeing. So even if there is an economic recovery, there could be bout of inflation. There will be some money moving out of gold because of chasing the economic momentum out there. But still, from other factors that we kind of fundamentally move gold, they are still looking positive. So there is a constructive, positive outlook on gold, even at these levels.
Okay, thank you. Next question, Sorbh. If profits of large companies have seen record highs, why are small caps expected to see a rapid price increase? Do you think small and mid caps are overvalued?
Yes, as I touched upon while I was talking about the smaller companies, clearly the kind of rally that the small and mid caps are seeing. So we need to understand what happens in a cyclical recovery. Now, larger companies are resilient; their business models are strong; they can survive down cycles. So they generally over the cycle they do well, but for mid and small caps, what happens is in a down cycle they fall very sharply because businesses are big, profitability tumbles very sharply for them. Now, in an economic recovery, they need a strong economic tailwind to do well. And because their profitable base over last 3 years have eroded, if there is an economic recovery and they get a tailwind, their profits could see a very, very sharp recovery. And that could be the reason that market expects them to do well and hence the rally. But clearly what we have seen through data that I presented, that these companies have inherent weakness in their business models. Most of them, not all of them, some of them are good companies. In case there is a setback on the economy, the stock price could take a very big hit. And clearly, there is a sense of complacency that is happening on the mid and small side. So, investors should be very, very careful while taking a bet on that. As of now, the mid and small cap seems to be factoring in all the economic recovery tailwind in the stock prices, and one has to be very careful while taking a bet on them. That's our sense. So there's a clear sense of complacency on the valuations and the stock price movement of mid and small caps. And there is a relatively higher level of uncertainty on economic recovery as of now, after the second wave took place. So one has to be very careful about it.
Thanks, Saurabh. So Chirag, next question for you. Why does Quantum recommend major allocation in the QEFOF, which does not appear to be tax efficient at all when compared to equity taxation?
So when we recommend QAFOF, it is for that investors should have a well-diversified portfolio. So apart from, because we don't know when and which style will outperform or underperform. So there is always a style risk that you're taking when you're banking on just one manager. And therefore you need to spread even your equity investments to be maybe 7, 8, 10 funds out there. And at Quantum, we do have value style. We have value managers. We understand that space. We understand ESG, we understand sustainability, and therefore we have an offering in that space. But apart from these two styles, investors should kind of diversify into various other styles. There are various other good managers out there, running various different styles. So investors should have allocation to all of that. And therefore, we think that given that there is a need for diversification apart from these two styles, and to a particular style, you should not have more than a particular amount of allocation. For example, say for a long-term equity fund, for a ESG fund, you should not have more than 10, 15, 20% at the max allocated to these styles. And you need to diversify into various different styles and build that larger chunk into equity fund of funds, because it helps you diversify across different styles. So that's the objective. Second, I think tax is secondary, but again, from a taxation perspective, it is not very inefficient. Like today, even today, equities are taxed at 10% taxation even after 1 year, which means that 10% taxation is gonna remain. And if you look at equity fund of funds, after 3 years, the taxation comes down to between 8 and 12%, depending on what the indexation levels are. So, 10% compared to a band of 8 and 12%, I don't think it is very, very inefficient, but it helps you in a very big way in terms of achieving your objective of diversification. You don't have to research so many funds. You don't have to track so many funds. You get a time-tested process, which helps you look at fund managers in a very detailed manner. And therefore, when you look at a more researched product, there is a better chance that it will do well over the long run. So, so that's our objective. It's not only achieving tax efficiency, but there is a bigger motive out there to help you diversify that holdings of equities that you have. And tax efficient, I don't think it is very, very significantly worse as compared to equities. It's very, very comparable, if I may say that.
Thank you, Chirag. Thanks for that. So Saurabh, Quantum Mutual Fund performs far better than peers, but suffers due to a low AUM. Are there any corrective steps in sight? Also, what's the relation between performance, fund rating, and AUM?
Yes, so our construct of the fund is that our performance is does not impacted by the AUM size. So we have a very strict definition of the capacity. So from a quantum long-term equity value perspective, our capacity is close to $5 billion, and we already manage some of the offshore money, which is close to $2.8 billion, running the same strategy as quantum long-term equity value product. So the size is not a constraint either on on the bigger side, or if the AUM is smaller or bigger. So that does not impact. We have a fairly liquid portfolio. So I don't think so that size does matter in terms of the way we have designed the product. And it's a very strict definition of what the size is, what stocks can we buy, and at what level of capacity we can scale up the product. So that's very well defined internally. From a rating perspective, the ratings generally are historical in nature. So ratings will have a historical bias. As Chirag was alluding to, that markets sometimes favor a style and sometimes it does not favor a style. And I'll just answer this question. One of the questions also, I'll just add that answer within this answer itself, because one of the questions was on the performance, 5-year performance. Now, last 1.5 years, since the time that economic recovery has taken shape and cyclicals have started to do well, the fund performance for quantum long-term equity value fund has improved considerably. But I'll just go prior to that, from between 2017 and 2019, what was happening. So as the economy was starting to slow down, some of the companies which were kind of sector leaders and had very strong moat in their businesses managed to grow despite economic slowing down and through gaining market share. Now, because there was ample liquidity in the markets, a little growth was chased by a lot of liquidity, which led to inflation, if I can say, hyperinflation in PE multiples for a few of those companies. Right. So being value managers, we will not be able to buy those names because we believe that there is an inherent risk in buying those companies at those valuations. Though the company is extremely good, but the stock is not good because it is highly valued. And in the correction, there could be a loss of capital, which will be very difficult to recoup. So that is the reason, being value managers, we refrain from buying into few of those companies. So one of the jewelry companies with zero EBITDA growth rate of 4 years was trading at 70 PE multiple. Similarly, an NBFC, fast growing NBFC, in 2019, January was trading at 6 times price to book, which was very expensive. Anybody who understands valuations will know this, that 6 times price to book is a very expensive valuation for any NBFC or a bank. When the year 2019 ended, it was trading at 12 times price to book. So that restricted us, and expensive became more expensive in 2017, 18, and 19. And because of that polarization, and we did not own some of those stocks which did well and which were part of the index, our performance suffered. Post March 2020, because the markets fell and we got a opportunity to buy into some very good names or sector leaders, we added those in the portfolio. And because there is a natural economic cycle, the cyclical started to do well, and companies beyond the market sector leaders also started to do well, some of which were in the portfolio, and that's resulted in the fund performance. Now, from here on, if we can talk about how things are looking from here on for a value manager, if this economic recovery continues and the market runs on both legs in terms of corporate earning upgrades continue to happen and liquidity, the value managers should continue to do well, because the stock price will move up because of earning upgrade and not purely on liquidity. But if there's a scenario which happened in 2017-18 that liquidity starts to come in, but the earnings upgrade do not happen, then it will be again a difficult time for value managers. So that's how our approach has been. And as Chirag was alluding in the previous question, that the different styles do well in different markets. Post March 2020, value managers have started to do well, and I hope if this economic recovery continues, we'll continue to do well. Within that, we have done some tweaks in terms of the way our process is designed, in terms of buy and sell and other things, so that we ensure that we maximize our benefit from the businesses that we own through equity returns. Thank you.
Thanks, Saurabh. So Chirag, a couple of questions on the Quantum ESG Fund. So the first one is, can you tell us about the QESG Fund, its investment process, and ESG scoring criteria?
Yeah, sure. As Sorbh said that, we have looked at governance as an aspect since 1990s, and it's been ingrained in our all investments that we do. So governance has been a long part, and we understand that very well. Come 2014, we kind of sensitized to the growing importance of environment and social factors, which we kind of said that this is getting very, very important in terms of opportunities as well as risk. And so we said that let's inculcate and build a process to measure an ESG performance of a company, and we can invest on those companies with a superior ESG profiles. So we built our own process, and we have an internal team that does that, a separate research team on ESG that looks at each companies, looks at their traits, and scores those companies on ESG. So when they look at scoring the company on ESG, they look at various parameters. Company discloses a lot of details in their sustainability reports or in their annual reports. And there are various other sources where we need to bank on to get more information on those companies. So we kind of collect a lot of data on companies, various parameters that we look at under all E, S, and G, where E stands for environment, S stands for social, and G stands for governance. So under each of these, like environment will measure what is the company, how is the company mitigating impact of climate change, what is the pollution levels or carbon footprint of the company, what are the waste management processes that a company has, is it kind of discarding waste in lakes, rivers, etc., or does it have a proper mechanism to dispose waste? How is the company at water management? Water is a scarce resource. Many of the cities in India are running out of water. And as they grow going forward, it's going to be very, very difficult for these companies if they just don't address that issue. So overall, we measure various different traits that the environmental factors for each company and measure how the company is doing on those. In terms of social factors, we look at how the company is handling its employees. Are there fatalities in the company? Are there accidents in their plants? Are the company employees satisfied in a way? Is there a big pay gap in levels, in terms of gender, in terms of is there an equal opportunity in that company? So is the company really looking after its employees or not? And we have seen time and again, if a company doesn't look at employees well, then the company will have some problem down the line. And it looks at all stakeholders, be it suppliers, vendors, shareholders, etc., in terms of how the company treats each of its stakeholders. In terms of governance, we see various traits like board independence, the quality of the board, what is the company doing in terms of treating minority shareholders, is it treating them at par or does not treat them at par. So there are various governance issues in terms of ethics, in terms of how the company behaves overall. So there are various things in terms of the board management that we kind of ascertain about that company. So in all these parameters, we look at 200, 250 parameters in total. There are things like data privacy, data security are becoming very, very important. That also comes part of ESG. So we look at all the traits of a company, which are non-financial largely, and see that with how the company performs on that. We don't ignore financials. We look at the financial stability of the company. What are the long-term ROEs? What is the debt level of the company? Is the company financially stable or not? So those are the things that we see. And we kind of look at getting companies which are kind of financially sound, at the same time are very, very good companies, well-governed companies, good in terms of looking at various risks, various opportunities. They're ready for that disruptive change, and bank on those companies to get that long-term performance. So the process is look at the ESG scores, look at diversification. We have investment guardrails, sector guardrails in place, which allow us to have a well-diversified portfolio. And within each of the sector, we choose the leaders, good companies based on ESG, and these companies, we bank on their sustainability practices to get that long-term returns. So this is in a way the way we go about investing in companies in ESG. And so far, though we have been into ESG, looking at companies since 2014, we launched fund after going through a learning curve, look at assessing companies in different ways since 2014 to 2019, and launched the fund in July 2019. So we think the process will continue to evolve as companies disclose a lot more data. There is a regulatory push towards that. There is an investor push towards that, and it is kind of becoming mainstream. So overall, I think the way we assess companies on ESG will evolve, but so far there is the performance tells us that in some shape or form it is working for us very well. So our idea of banking on sustainability has rewarded in terms of a handsome performance over a short time frame. I'll say a short time frame because it's just about 2 years that we have completed. But also keep into mind that it has gone through its own cycles, and each of the phases of the cycle, it has delivered a superior performance. So that is very, very encouraging for us.
Okay, so the second question is a follow-up from this. So what is the risk associated with QESG, and what is the future of sustainable investing both nationally and globally?
So I think there are various trends that come into market, but this one is not a fad. It's here to stay. I think it will only become mainstream going forward. Many global investors, all the regulators are very, very serious on ESG. Like the idea is to bank on sustainability, and ESG as a process is leading to identify companies that are sustainable. So ESG is kind of a process that helps you identify sustainable companies. So I think the future is significantly bigger. It is, if you look at the signatories that are there, all global investors are saying incrementally more of my investments will move towards ESG. And there are predictions or forecasts that say that, at some point in time in next 5-10 years, it will be equal portion of the investment world. So traditional investment styles will be 50% and ESG will be 50%. And there is a strong need, or most investors looking at integrating it with most of the styles that are there. So I think ESG as a way of investing is here to stay, and it will only grow bigger, and it will continue to evolve and get better. So so that is the way we look at ESG. In terms of the risk that you alluded to here, ESG doesn't, the way we have built it, it doesn't look at valuations per se. So there could be some companies that could be higher PE, but at the same time, we have seen that, these are leaders in their sectors, they have high revenue growth, they kind of continue to build as a chart that Sorbh showed, bigger is getting bigger, right? Smaller companies are getting knocked out by the bigger players. The bigger players are getting market share. And that is where we have seen these companies' performance get enhanced, because these are bigger, superior leaders in their own sectors, and therefore they have done well. In terms of risk, there is lesser blow-up risk associated with ESG companies because they are better taking good care of risk management. They are ahead of the curve. They are ahead of regulation. They are ahead of the disruptive changes that are coming through. They are prepared for the next phase of growth. And so from that perspective, I don't see, but from a valuation perspective, there could be some short-term risk. But at the same time, we have seen that the way we have addressed that issue is by having a well-diversified portfolio. So have good ESG companies, have a diversification in place. So there may be some sectors, some companies going through a painful period because they are a kind of overvalued. But at the same time, there will be a better future for these companies, given the sustainability in terms of good board, good management will address how they kind of keep up with the growth pace that they have to deliver. So overall, I don't see more risk, but there are more rewards for investors out there.
Okay. And why is the expense ratio of QESG almost double compared to other ESG funds? For example, the SBI ESG fund.
So I think SBI ESG fund is around 0.5, 0.6% expense ratio. We are at 0.9. If you look at what we have built is our own in-house research on ESG, whereas most other players out there are banking on third-party research. They are kind of outsourcing ESG research to third parties and using the scores that they give to kind of build their investment. So, so that is a very, very big difference. And that is where our quality stands, which is also reflected in relative performance as compared to what SBI has delivered and what our fund has delivered. So I think the reliance on our own research has really helped us, to know the nuances that are there in ESG, and therefore build a better process around how we go about investing through ESG. So that is a big difference, and I think that is where we kind of have a slightly higher expense ratio than SBI. So I think that explains most of it.
Okay. Thanks, Chirag. The next question is addressed to both of you. It's is QLTEVF a better equity scheme to invest in currently, or should one reallocate their money into QESG, which follows sustainable investing? Can you shed light on the equity investment allocation?
So the way we recommend investors, and it has to be, it is not QLTEF or QESG, it has to be QLTEF and QESG together, because both have a very different style, and investors need, and both style add tremendous value to portfolios. One is a QLTEF, which Sorbh can allude more on, provides that safety of a cushion in terms of safety of margin, take the calls at the right time in terms of things look frothy or value. They will kind of sell out in a disciplined manner and raise cash. So it has its own positives. At the same time, ESG has its own positives in terms of it gives you sustainable investing. It gives you investing that is kind of getting mainstream in terms of banking on sustainability. And we have seen that it works at the company level, at an index level, and in a fund level. So there is a plethora of evidence out there that it really works. And we think that we have a superior methodology or a process on ESG, and it's all in-house, and that gives us an edge. And therefore, we think that it has to be a well-diversified allocation of equities. So the way we recommend is about 15% in QLTVF, 15% in QESG, and about 70% remaining in QEFOF. And that makes a good equity basket. If you invest in just 3 funds, you're sorted on your equity investment needs. You get exposure across styles, across different fund houses, across the 2 important pillars like value and ESG. Sorbh, if you'd like to add anything.
Yes, almost all things are covered, Chirag. Just to highlight how both the funds are constructed. So there is a common platform called governance, which is like at the genesis of the quantum, this was something which is of paramount importance, governance of companies where we invest. So governance is the underlying theme on both the funds. Now, quantum long-term equity value fund adds a certain liquidity in terms of stock filters and valuations. So valuation is the second most important parameters after governance when we are trying to create a portfolio for quantum long-term equity value fund. So we would like buy companies at certain valuations with margin of safety. Whereas when you compare ESG after governance or with governance to get social and environmental concerns, and when those companies do well in ESG parameters, those go to QESG portfolio. They can make it to the QESG portfolio. Now, because the governance platform is same in both of them, there could be some overlap in the portfolio, but the reasons they are in the portfolio in quantum long-term equity value is value plus governance, and they are in the portfolio in terms of QESG is because they pass the filter of governance plus environment plus social. So in QESG, valuation is not a concern. It's based on construct, and as Chirag alluded, that good companies which have focused on ESG and benefits all the stakeholders over long terms will give you superior returns. Where in quantum long-term equity value, the thought process is that if the company's governance is good and we buy it at a valuation which is attractive and has margin of safety, you will get your commensurate return. So that's how both the strategies are different, and allocation, Chirag has already explained how to allocate between these 2 funds.
Yeah, thanks Chirag and Sorbh. Saurabh, while you've explained quite a bit on the QLT EVF, there's one recurring question that keeps coming in, which is why the expense ratio of the fund is so high compared to other equity funds at industry level, and if there's any scope of reducing the same.
Yes, so I think when we started off, we were the only one who was offering the product direct, and when we compared to other regular funds, we were clearly one of the low-cost funds available in the market. We clearly have a roadmap, and as you know that about 1.5 to 2 years ago, SEBI gave a roadmap to all the funds to reduce their expense ratios based upon the AUM sizes. Now, much before that, about 5 years before that, Quantum itself on its own has given a roadmap on the AUM sizes and reduction in expense ratios. So now, as the fund size increases, we have thresholds of 1,000 crores, 2,000 crores, 3,000 crores. When the AUM reaches at those thresholds, expense ratios will come down. And this roadmap was given much before the SEBI mandated roadmap, which is now given by everyone. So the expense ratios will come down as the AUM increases.
Thanks, Saurabh. So this is our final question, which again I'll address to both of you, and then we go into closing remarks. So if there is a third wave and a fourth wave of COVID, what will happen to the Indian economy? So Chirag, you want to go first?
Yeah, sure. So it will depend on how severe it is. If it is kind of as severe, as tragic as the second wave, I think it will have a far higher repercussion on the way the economy is. It will get extremely difficult, and economy will be in a very bad shape because we are not still addressing the issue surrounding building healthcare facilities out there. So again, as we witnessed the issues in terms of hospital beds or non-availability and lesser doctors, nurses, medicines, oxygens, that could again be a repetition if things get equally worse in this third, because we have not taken time to addressing those issues at this time also. So it will be a very bad shape if it is equally severe. And in that case, the markets will take a very sharp beating if we were kind of go through a very severe third and fourth wave. So only thing that can help us is vaccination. I think if we have a better strategy, that will instill a lot of confidence in the people in India, as well as from global investors. So that is a strategy that I think we'll have to solidify. If not, then we will surely get a third and fourth wave. The only thing is we don't know how severe that's going to be. So that's a big uncertainty. And we'll have to live with that uncertainty until we get the vaccination going on in a big way. So that's about my 2 cents on how markets will react or how the economy will be impacted. And we are each time we kind of try coming to our feet, we are being knocked down with the infection spread, like we saw in second wave, right? So we, as Saurabh said, that we just kind of started rolling out more jobs. We kind of hit by a second wave, and it kind of the process got stalled. So each time if that kind of happens, it will build a lot more uncertainty. People will want to keep a lot more cash with them because of the medical emergency or other things. So overall, it could be a serious impact on investments if there is a severe third and fourth wave.
So yeah, hi. So just to add on to what Chirag was saying, clearly this that would be clearly negative, and markets, especially equity markets, are not factoring that, because the only thing equity markets are now factoring that there is a vaccine on the horizon, and sooner or later that will come and things will be all right. If that confidence goes away, there clearly will be a knock. But within all this, one should not forget the human ingenuity of surviving things and making good out of bad, and that intention to survive and move around and things like that. Because we have seen how people have evolved over first wave and second wave. When there was a first wave stringent lockdown, everything ending, even companies initially did not know how to operate. In second wave, that transition has been much smoother for everyone at the individual level and at the corporate level. So that is also a factor. So we should not be thinking about too much gloom and doom. It will be a knee-jerk reaction clearly, but we believe that vaccines are until unless there is a mutant where vaccines won't work. That is a real big negative surprise. Then we again go back to the uncertainty that we were facing in March and April 2020. But we believe it till the time on the horizon there is a vaccine which will come sooner or later. There could be a knock because that third, fourth wave is a negative surprise, but things will move on. So I don't want to end with a gloom and doom kind of thought process over here. And this human ingenuity we have seen historically. There have been wars, there have been pandemics over, and things get over. We get over those things.
Yeah, absolutely. Thanks, Chirag and Sorbh, for that question. And now the floor is open for any closing comments. So Chirag, we'll go with you first.
Yeah, so I mean, we have seen like so many crises since 1994. There were like 17 dislocations in markets, and markets kind of moved beyond those at some point in time. So it is very, very difficult, to get which asset class when to do, and therefore asset allocation work really wonderfully for everyone. And at this juncture, when there is uncertainty, you can bank on a manager like a value fund because there is already a margin of safety, or be it timely action they will take, or you bank on stability. So those are two strong pillars that I would suggest that investors can rely on. And don't forget asset allocation. It always works. It has and it will continue to work. So have a well diversified portfolio. And then be it COVID or any other uncertainty, I think you will be able to live with those. So have a well-diversified portfolio, that's what I say.
Thanks, Chirag. Sorbh, any closing comments?
Yeah, rightly as Chirag said, first of all, please give importance to your health over finances. That's the most important takeaway we would like to share with you. Stay safe and stay healthy. And from an equity allocation perspective, yes, staggered approach is good. There is some sense of complacency that is creeping in the valuation, especially on the mid and small side. So be careful. I think in this environment, an active manager who thinks about risk and can manage and maneuver your portfolio in uncertain times, allocating to those portfolio managers would be a good thing to take care of your finances as far as equity allocation and other financial allocation goes. But that's about it. And thank you for participating in this call for 2 hours. Thanks a lot. Be safe. Thank you.
Thanks, Sorbh. So with that, we're concluding the session. Thank you once again for joining us for this webinar. Our speakers have tried to answer most of your questions. However, in case you have any further queries, please do get in touch with us. You can visit our website, www.quantumamc.com, or get in touch with our customer care team. A recording of this webinar will be uploaded on the Quantum YouTube channel next week. Thank you, everyone. Good night. Stay healthy and stay safe. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.